Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 276 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in the world of financial markets and financial planning. This week, we are pleased to welcome Seth Golden back on the show. Those of you who have been longtime listeners know that Matt and I both love to discuss Seth's research on the show quite frequently. And Seth joined us most recently on episode 234. So Seth, welcome back to the show.
Thank you. Appreciate you having me back. I know we got a lot to talk about today. Love your platform. Love what you guys do. Just kind of, breaking things down for investors and really easy to understand terms and practical approaches to allocating capital.
Yeah, well, we appreciate that, and you're a large part of the platform now since we share your stuff so much. But for those people who haven't listened to the previous episode 234 with Seth, Seth is a hedge fund consultant and chief market strategist at Phenom Group. He's a 17-year veteran of the consumer packaged goods and retail industries and has been an independent trader and economist since 2000. If people want to learn more about Seth's background, you can go and listen to the first 10 minutes or so of episode number 234. But like Seth said, we have a lot to get to today. But before we do that, we want to quickly review the month-to-date and year-to-date performance of the major market indices that we track. This data is from YCharts and as of the market close on November 6th. S&P 500 index is up 3.9% for the month of November and up 24.3% for the year. The Dow Jones Industrial Average up 4.7% for the month and up 16% for the year. The NASDAQ Composite Index up 4.9% for the month and up 26.5% for the year. The Russell 2000 Small Cap Index up 8.9% for the month and up 18.2% for the year. And the Vanguard All World X United States ETF up 0.4% for the month and up 7.5% for the year. 3-month Treasury rate at 4.64%, the 2-year Treasury rate at 4.27%, and the 10-year Treasury rate at 4.42%. So Seth, kind of just jumping right into it. There's a lot going on right now in the markets and the economy. We just got done with the presidential election. We're right in the middle of earnings season, and it's widely expected. Yeah, right. It's widely expected that the Fed is gonna cut rates again today. I'm sure you, like us and so many more people, are very happy that the election is behind us and we don't get to see the political ads every other commercial and the yard signs all over the place. But with everything else going on, how are you navigating the market right now, and what are the things you're paying attention to?
Yeah, so I guess, starting from the beginning of the year, it's just understanding how analogous the market has been to the average presidential election cycle year. So largely, just having position for that coming into this year, I think the path has been very similar to all election years. The main difference is just the magnitude of the S&P and NASDAQ's return, Dow Jones's returns year to date was much more substantial, and the lack of a full correction. We haven't had a 10% correction since October 2023, and not many people had that on their bingo card. So riding large cap growth has been ideal this year, and that's we wanted to position and be where we thought the outperformance was going to come from, and we saw, based on the proliferation of the AI theme and continuation of the CapEx spend in that area of the market and industry, we stuck with it. So we've been in some of the Magnificent Seven names. We've also peppered positions in small caps. Coming into this year, there's been material underperformance, not just from a fundamental perspective, valuations, earnings drivers, but just on a price perspective as well. Small caps really didn't participate much in 2023, and they got kind of stuck in this sideways consolidation pattern for almost 3 years. So we had a lot of data to support the idea, the thesis that small caps would break out at some point here in 2024. So we wanted to make sure we positioned for that as well. Having an underweight, but still capital allocated to the small cap area of the market. And that's the way we started at the beginning of the year. By the middle of the year, we got to an equal weight position in small caps, doing a lot of trading to kind of build up the position with a really low cost average. And then all the data started, the technical analysis started to bear fruit that there would be a clean breakout in small caps. Did we think it would take the election to do so? Not necessarily, but we'll take it either way.
Right.
So this breakout here enables us to basically make a decision. Do we want to ride small caps through the end of the year with that position, or was it a rent to own type of trade, 9-month or so trade? And still kind of contemplating it, have more data to look at. And one of the things that we recently researched and understood, since we do have a declared winner from the election, we look back at the last election that President Trump won, and what we saw is that small caps had the biggest index post-election move. And through the end of 2016, so the election date was November 8th, and through the end of that year, 2016, small caps rallied 12-13%, whereas the S&P and NASDAQ rallied, I think, 3 and 4% respectively. So if history repeats, and we know it doesn't always repeat, but it has a good tendency of at least rhyming, we think it may be ideal to stay, with a small cap allocation through at least the end of this year.
Yeah, and I think for people, Seth, they might be a little confused. Like we just said, small caps did really well after Trump got elected in 2016. And, the anticipation, at least with the market action one day after the election, is that small caps are getting ready to start moving and outperforming again. Can you just take a minute and tell listeners why investors like the small cap trade with a Trump presidency?
It's short-lived. I will, caveat, the conversation with that, or my answer to that is it was a very short-lived period of outperformance. It literally died at the end of 2016 and through the rest of his first-term presidency. 2017, small caps underperformed. 2018, they underperformed. 2019, they underperformed. The winners remained large cap, and more specifically, the NASDAQ outperformed all indexes from 2017 up to the pandemic. Could it be different this time? Could you carry some more small cap outperformance into the out years? From a valuation standpoint, I would say this time's different. Small caps are far more undervalued than they were at the start of the last Trump presidency. So if there is a tailwind for outperformance to continue into 2025, that would be one tailwind. On an absolute basis, you have depressed valuations in small caps. The other thing that I would probably caveat with is you want to be picky and choosy so far as the small cap space. I would probably favor small cap 600, the S&P 600 relative to the Russell 2000. The S&P 600 has many more companies that actually have earnings than the Russell 2000. so-called zombie companies, if you will. So I would be, if somebody had the inclination to go into that area of the market, I would probably, best advise to do so in the S&P 600 as opposed to the Russell.
Got it. Quick follow-up there, Seth. I know that there might be some enthusiasm with smalls in regards to the lowering interest rate environment. You look at history, the tendency of small and mid caps, at least after that first interest rate cut, to outperform for the first year. The data supports that historically. And I think the other factor at play with the Trump win is the perception, whether it turns into reality or not, that a Federal Trade Commission under this administration will be more friendly to merger and acquisitions. So I think what'll be interesting for investors to monitor, and I absolutely agree with your assessment of 2016 and how, it was really that Q4 where the strength was, and then it kind of died off after that. If you have a Federal Trade Commission in 2025 that is more willing to approve merger and acquisitions,
Yeah.
that's another aspect that can kind of heat up that small cap trade. You know what I mean?
Good point. A very good point. And, so far as that, rate cuts, lowering rates, there's some nuance that, within that data, so far as when the Fed cuts, you usually have the first 6 to 12 months of outperformance coming from small caps. The nuance to interject there would be barring soft landings. It's
there you go.
Most of the time that performance happens because the Fed is doing recessionary cuts, not soft landing cuts. So that's the nuance in the data. When it's a soft landing or no landing cut environment, the Fed is effectively lowering rates, but they struggle to actually lower yields. Yields don't necessarily follow the rate path to the same degree that they do in a recession. So the probabilities for small cap outperformance, if indeed this is a soft or no landing rate cut cycle, is not as strong for small caps if it was an actual recessionary rate cut cycle. But to your latter point on the FTC, absolutely. If there is an environment where the FTC is more friendly, you're going to get speculation alone will serve as a tailwind for the small cap arena, let alone realized mergers and acquisitions. The only thing there is Vance has actually said, Vice President Vance has actually said on the campaign, and forgive me if this is political, it's just, stuff
No,
I listen to.
it affects investments so far. You're doing great.
Yeah, so he's actually praised Lena Khan with respect to how she's, carried her role in this environment. So I don't know. And that, how much sway does the vice president actually have when it comes to, putting these people in place in the cabinet, let alone, in government positions. So what he says and what actually materializes may very well be different. And I would think if, certain of the policies that the Trump administration campaigned on, come to fruition, there probably will be a lot of overhaul in the personnel in some of these agencies.
That's great insights.
And I think the one thing I just wanted to point out to wrap up on the small cap discussion, and we can move on to the next topic, Matt, is, I'm always a big fan of, and I don't know who coined this term, the bigger the base, the higher the space. And that has certainly been the case with small caps, because like you said, Seth, it's just been stuck in this trading range. Stocks can go up, they can go nowhere, or they can go down, right? And small caps really for the past several years have gone nowhere. But when they do ultimately make new highs, I think there's a higher than 50% chance that there could be more room to the upside to run for small caps. So
yeah, I would tend to agree. I mean, when you get technical breakouts, especially after a protracted period of time, you probably want to lean in favor of more upside than a false breakout. I mean,
Right.
2+ years of sideways trading actions in an index, and an index. Individual stocks may be something different, but an index, and it finally breaks out, you probably want to be on that rocket ship with it.
Yeah, exactly. And not to mention an index that's been chopping sideways where most other indices across the world have been in a steady uptrend, right?
Right. Yep.
So yeah, so I just wanted to point that out for listeners. But Matt, I know you had a couple of things you wanted to talk about, specifically talking about the fallout from the election or implications of the
Yeah, I
election.
mean, since we're blessed to have Seth on the podcast, I think we should just tackle what's on everyone's mind right now, and that's, what do we feel are going to be the short-term and or long-term implications, of the election yesterday. And so, Seth, I know Mark and I might have feelings as well. Obviously, you are an honored guest. What comes to mind when I say that? Because it's probably on a lot of investors' minds right now. I know we talked about small caps. Outside of small, where does your mind go when I say those things?
I try to step back and think about the big picture where we are. So since 2020, if we just just the last 2 years, the index has moved up from the October 2022 lows. The large cap index, S&P 500, is up more than 60%. We haven't had a 10% correction in more than a year, I just mentioned. So I tend to look at things through the lens of quantitative data to decipher what the possibilities or probabilities are going forward. Anything's possible, but as investors, we want to know what the probabilities are. It's like when you go to Las Vegas, right? You want to stack the deck in your favor, and quantitative analysis allows you to do that. So I would be projecting 2025, again, looking at history. And if we do indeed have a red sweep, which by all of the betting markets, which seems to be the best way to look at things nowadays as opposed
Right.
to the bulls.
Where the money's at.
The betting
Putting your money where your mouth is rather than just answering a poll, which I still have not been called for one of those polls before, so I don't know who specifically they are calling, and I don't know anybody that has been called for an election
me either.
poll.
I've never been either, so in the same camp. But yeah, I mean, the betting markets, it looks like it's going to be a red sweep. And so if we look back in history, how does the S&P 500 do? When there is a one dominating party in the House and the executive branch, it's not very favorable. Returns are lower than average. Annual returns are lower than average. And the hit rate, the positivity rate for any calendar year, is only 60%. It's almost a coin flip, right? It's almost 50-50. So the probabilities based on a clean sweep just aren't as good as if you had divided government. The sample size is small, all right? But we rarely have, whether it's a blue sweep or a red sweep, sample sizes are pretty small. So, given that we're already up 65% or so over a 2-year rolling period, we haven't had a 10% correction in over a year. I would say, next year could be pretty choppy. We do, if you just look at the first year of a, new presidential cycle, you do tend to get positive returns, but it's not the best. It's usually the first 2 quarters are where you see the best returns in the first year of a presidential 4-year cycle. So, I'm looking at this window that we're in right now, which is the best 6 months of the year to own stocks, November through April. Wouldn't you know it? That tends to be where, the best returns also are in the first year of a presidential cycle. So I think we still have gains, to come, as long as we don't see recession on the horizon, earnings are still growing, and inflation or disinflation is still the trend. If you have those pillars, I think you still lean into buying dips and sticking with large cap growth from a probabilistic return standpoint. if I was looking at a portfolio pie chart, if you will, I would still favor large cap growth in the overweighted section of that pie chart.
Seth, great insights. And just to kind of add to that, to give our listeners and viewers further perspective, where I stand on this from my opinion standpoint is if the administration is successful in lowering regulation in many industries, I'll just name a couple: energy, financial services, industrials, all of that cost savings tends to flow to the bottom line, more profit. When you look at the other aspect, if they are successful having control of Congress, the Republicans, in lowering the corporate tax rate, which is something they campaigned on, that's another aspect that will flow to the bottom line in profits. But here's the important point for investors to remember. Wall Street, generally speaking, is all about year-over-year comparisons. So for example, for some of our newer listeners, when a company reports third quarter earnings, which they're in the midst of finishing up right now, they're comparing to what that company did a year ago in that same quarter. I think one of the things that could make 2025 a little bit better than people anticipate is you're now going to have these year-over-year comparisons, assuming the administration is successful in those two areas I mentioned, to where the comparisons are going to look a little bit better than they normally would. But then we get into 2026, and the problem at that point is all that stuff is baked in. It's right, Seth. It's baked in. The bar is there. You already had the savings of a lower corporate tax rate. You already had the savings of a lower regulation. So if I had to look at this from a very long-term perspective, I think where the market has a really tough period of consolidation and comparisons from a financial standpoint is when you start creeping into 2026. And guess what? It's a midterm election year.
There you go.
And Mark McEvely has talked a lot about this on the podcast over the years, midterm election years. And Seth, you know this, of the 4-year presidential election cycle is the worst.
It's the worst year. Yeah, it's the worst year for returns. The average correction going back to 1928, the average correction in a midterm calendar year is 17%. And if we just think about the last two midterm years, 2018, we had a bear market, a 20% technical bear market in the fourth quarter, right? And in 2022, right? The last two midterm years, we actually had two bear markets. So I'm fully on board with that. One of the things I always, talk to, especially, these upcoming hedge funds, is follow the presidential calendar year. You always want to have, I never want to promote the idea of being underweight markets from a discipline standpoint. It's always just the best to ride it through, right? Because are we really going to time it? And if you have an outlier midterm election year where you don't get that serious correction, you actually have, right, then you're playing catch up. So, but I do promote the idea of having excess cash on the sidelines during a midterm election year. It's like one of the things that I've learned, because there's also a 100% study. If you buy midterm calendar year, if you buy November 1st and you hold Spider Index ETF, right? If you buy November 1st and you hold to the end of April of the next year, every single time since 1928, you had a positive return. Every single time. And the average return is 8%. So if you have all that excess cash and you can be patient and ride through 2026, and then you get to November 1st, 2026, you hate to say there's a guaranteed trade there, but history doesn't lie. If only if it only rhymes, you're in good shape. And there's a lot of different quants for every year of a presidential calendar year. But that midterm quantitative study is bar none, one of the best.
Yeah, for sure.
That's great stuff.
Important date on people's calendars, November 1st of 2026.
Yes.
So, and Seth, talking a little bit more about what Matt had brought up, are you looking at certain sectors with a Trump presidency? I think it, the sector conversation can get a bit confusing, right? Because I think in 2016, everyone was like, "Oh, the oil trade is going to come back because
Yeah.
Trump's, pro oil." And it was actually the complete opposite, right? So
Yeah.
your traditional old school oil and energy significantly underperformed, and the new, green energy significantly outperformed, which was
Right.
confusing. And then to confuse people and put their brains in a blender even more, when Biden got elected in
Yeah, I was good.
2020,
Yeah.
traditional energy did really well and
Right.
green energy
Right.
did poorly. So that can really confuse people, right? And I think it, also goes back to, markets price this stuff in way in advance, right? But what are you seeing from a sector standpoint, in your opinion, that, people might want to focus on a little bit more than they really have been over the past
Right.
couple of years?
So I go back to June, and I hate to talk about sectors by mentioning a specific stock, but how can you not when the market as a whole is dominated by tech? And tech itself is dominated by two stocks, Microsoft and Apple. So the reason why I say go back to June is because in June we had the Worldwide Developer Conference for Apple. And the stock took a big hit. I think it was down like $5 that day. And I'm watching it live and I say to myself, yes, yes, I like this. I don't care if the stock's going down. I like this. I think it dropped into the high 180s intraday there. And I said, I like it. I think this is a game changer in terms of finally getting that more material iPhone upgrade cycle. And then the material service sector revenues, which are, 80% margins for this company going to the bottom line. It's just a matter of when, these applications, basically are solidified on the iOS platform. So I was a buyer of Apple when it was, in the low 190s during the WWDC. And sure enough, the very next day and thereafter, it just ripped to the upside. I think that this iPhone upgrade cycle is going to be significant. The pace of it, I think, is the only thing in question. But because you essentially have two stocks that dominate tech, Microsoft and I think that, I don't know, 40% of tech. And as tech goes, because it's 31% all-time high weighting in the S&P 500 now, even greater than the dot-com period, it is going to be difficult for the market itself to go down and stay down in 2025, and assuming that this plays out in the upgrade cycle for Amazon. Because what's good for Amazon, believe it or not, for Apple has always been good for Microsoft, despite the competitive nature between the two companies. So if there is a backstop or a put, for the market, if these fundamentals actually play out. Imagine that the S&P 500 has done what it's done with little EPS growth and revenue growth from the second most heavily weighted stock in the S&P 500 and NASDAQ. And then when it actually starts to generate that outsized revenue and earnings growth going forward. So that's one of the reasons why I do still favor tech and large cap growth. The other sector that, while I've already benefited from positioning for it, in 2024, I'm starting to also see favorable data and propensity of earnings growth going forward is healthcare. I came into this year, healthcare, just like small caps, had materially underperformed for basically 2 years. So there, when was the last time healthcare has ever underperformed or at least not made new all-time highs for 3 consecutive years? Never. Hasn't happened. So there was a good probability healthcare was going to make an all-time high in 2024, and it did. So that played out well. But then we've had a pretty significant consolidation here where it's come back into, basically into a box, into the trading range that it's been in, for the last 2 years. And it's largely because some of the outperformance and weighting of Eli Lilly inside of the sector ETF and what just happened to Lilly over the last, when it recently reported. But I look at that as saying, okay, we get that out of the way this year, and healthcare has still benefited. When you look at the whole of the year, it's still up. There's still room now that we've actually set a low bar with Eli Lilly, readjusted the weightings a little bit within the sector ETF, and it's still kind of in this trading range. There's the probability that the Pfizers, the Mercks, the Eli Lilly's rebound, the Novo Nordisk, that these will actually support more earnings growth for healthcare in 2025. So I actually favor sticking with healthcare and going back to the probabilities for a good correction of 10% or so in 2025. Where do you want to be? Healthcare is both growth as well as defense. And so it checks both of those boxes in a tactical portfolio for 2025, in my opinion. So I like those two areas.
Right.
Interesting insights.
A part of that, a part of the healthcare sector, an industry group in biotech. Another spot in the market that really hasn't gone anywhere in a long time, right? We got a little bit of a breakout earlier this year, but it's kind of pulled back and hasn't really started to move higher yet. So that's an interesting part of the market to consider.
New folks in the FDA with the new administration.
RFK, making America healthy again. It'd be interesting to see how that affects the healthcare industry in this country.
And who knows, Mark? It might be like the energy play back in 2016. Everyone, it could be, he's reforming the FDA, and Seth's right, and the healthcare stocks do well. People are going to be like, what? Wait a minute.
Yeah.
But you could argue a lot of that's priced in already, and I think that's an argument to a certain extent that Seth's making, and that makes sense. From a time standpoint, before we go to the next topic, any comments, Seth, you have regarding the word tariff? If you go back to 2016, everyone in Wall Street all of a sudden became a tariff expert, if you remember that.
Yeah. We
so
went from being tariff experts to pandemic experts. All in the span of 2 years. Aren't we fast learners, right?
Yes, we are. And I know it's going to be a hot topic over the next 6 to 9 months. Before we switch topics, doesn't have to be long. Anything top of mind, and you can just say pass as well. Any thoughts on that comment?
Yeah, I mean, I'm a free markets guy. If tariffs are kind of, the government intervening in trade, akin to saying the federal bank interfering with allowing markets to clear during crises or euphoric periods, right? So I think we're better off if you let markets clear, whether it's from the economic side of things or financial markets side of things. Recalling the episode from 2018 when the trade war started and tariffs were implemented, 30,000 foot view, so to speak, because I know the inflation buzzword gets attached to tariffs because it's fact. That's what the data bears out. You put in place tariffs, you're going to get a degree of inflation. What that degree is remains to be seen. What it was, from 2018 to 2019, did produce a 50% climb in CPI and the PCE. Remember, prior to the trade war and the tariffs, I mean, we couldn't get to 2% on PCE. We couldn't get there to save our lives.
Mm-hmm.
Then you had the Tax Act in 2017 combined with the tariffs in 2018. People had more money in their pockets, things costed more, and we got to 2.1% is I think where we peaked on PCE. So I just on that basis, we do have factual representation that tariffs lead to some degree of inflation. So in thinking about it that way, however, the biggest components of inflation are and always have been housing and energy.
Correct.
That's not what we're taxing, or I'm sorry, tariffing. That's not part. It's the good stuff. It's the metals. It's the iron ore. It's the the stuff
Consumer
coming out of China.
discretionaries.
Right. It's consumer discretionary, raw material stuff. That has very low weighting in CPI PCE.
Good viewpoint.
If you don't kick something off when it comes to energy prices, oil obviously being the major component within CPI, and you don't see major inflationary moves in housing, this is not really the conversation the Fed cares about. It's more or less, okay, you want to fight with China, you want to fight with the the Asia Pacific Rim, go right ahead with your goods from here and your goods from there. It just doesn't have much of a read through to what the Fed looks at in PCE.
Great insights there. Great insights. Mark, we have time, I think, for about one more roundtable question. Would you like to ask it, sir, or do you want me to?
Go ahead.
So I had one teed up here near the end, and I always love your insights on this. As our regular listeners and viewers know, a lot of your work is centered around the VIX and volatility. And so any updates on the VIX that your research is indicating, but before you respond, maybe incorporate your thoughts on the term that the one and only Seth Golden has coined, Volmageddon or Volumegeddon. How would you pronounce that properly, Seth?
Volmageddon, yeah.
Volmageddon.
Yeah, Volmageddon.
So as you chat, I'm going to kind of share my screen, and I'm going to share a post that you had on November 5th, and it was quoted, "Markets are clearly overhedged. If the left tail risk doesn't actually materialize, election sweeps, etc., potential inverse Volmageddon might occur. I'm paraphrasing. So as you respond, I'll just share this with our listeners and viewers, and Jenna, if you could enable that ability, and then we'll see what you have to say, Seth.
Yes, I mean, if your audience doesn't, know, my background, I'm the Target guy. I was that guy that used to work at Target, then basically became an independent trader, and my number one strategy has always been shorting volatility. And so I basically rode that strategy from 2012 into 2018, using various instruments within the volatility complex, mostly VIX exchange traded products. Some people use exchange traded funds. Some of them are exchange traded notes. I say they're just exchange traded products. Let's put a P after it and not worry about it. So in 2018, because the short volatility positioning had gotten so large, and we hadn't had throughout 2017 any major correction. I think the biggest pullback in 2017 was 2.5%. We also had the lowest VIX reading in history in 2017, in the 9s, or maybe it dipped below 9.
That's insane.
Yeah. And then, well, what do you think happens next, right? You go from a very depressed volatility regime where everybody's loading the boat, pushing down volatility with short volatility positions. The assets under management, or the AUM for a lot of these different volatility products explodes higher. And then all of a sudden you get a significant pullback in one day, early 2018. I think it was February 5th. It's like down 5%. Intraday, the VIX shoots up. VIX futures are up more than 100%. And some of these exchange traded products, volatility exchange trade, they just exploded. And so you had all of these short volatility traders just deeply underwater. And unfortunately, a lot of times when brokerages can't assess the risk to the brokerage from positions in the options market, they essentially lock client accounts because they don't know how much risk they've allocated to clients. So that was Volmageddon. We had a big spike in the VIX from, 11 to 36 on February 5th.
Massive.
And you had Yeah, and you had a doubling of VIX futures. They were up more than 100%. So all these products just basically exploded and wiped out a lot of short volatility traders. So that was Volmageddon 1. Fast forward to pre-election, and we know that the VIX itself, VVIX as well, which is the volatility index, if it doesn't get any more crazier than that, right? I mean, volatility of volatility, that's how how many different products that we've decided as an investing population we
How many
need.
different derivatives
Yeah,
of
how many
different
different
things do we need?
derivatives? Yeah. So people have just been piling into hedges, ahead of the election. Right? They're buying long volatility. They're buying VIX call options. They're buying VIX futures. They're
As an insurance
buying
policy, they're hedging,
insurance
right?
policies, right? But if you get the opposite move, meaning a positive move in post the election, you remove the tail risk, right? The right tail risk was if it was a contested election or we didn't know for several weeks, then you could see possibly more volatility and depressed equities. But if you didn't get that, if there was 4 scenarios and there was only one scenario that would produce more volatility, well, you essentially have created your own risk in your portfolio through all of this excess hedging or long volatility exposure. What we know happened when I looked at positioning and I see the trend going into, I'm talking the very week ahead of the election, I already saw some of these long volatility positions being unwound, which tells me, based on the open interest, these were sizable, a lot of volume in the hundreds of thousands of contracts being unwound. If you get a positive reaction from the election, there's going to be a lot of existing exposure in the long volatility paradigm that gets deeply overwhelmed.
Yep.
So you went from having a hedge, and if you get a big move in the VIX, if you get a big move in VVIX to the downside, that hedge could possibly overwhelm your entire portfolio.
Yep.
Even if it was 2, 3, 4% of your long exposure and the VIX went down 20%, you're looking at, basically a 4x magnitude position now relative to your long exposure, essentially creating your own Volmageddon inside of your portfolio.
And I could argue your post was spot on November 5th, and that's exactly what happened yesterday.
Exactly what happened. And here's the sad thing about it, in my opinion, we always hear about risk management being number one because it's just, it's a good promoting of, cautiously investing. It's a way to promote diversification in a portfolio, never being too overweight and concentrated, and hedging. There's always this idea that risk management and hedging go together. We're not going to hear about a litany of hedge funds that are going to have to close up shop because they were overly hedged and essentially have to liquidate because of that hedging. We're not going to hear about it because it doesn't promote the idea of risk management. Now, on the short volatility side of things, back in 2018, it was megaphone. Who are these idiots shorting volatility? That's not good risk management. That's just, you guys are crazy. You deserve what you get. And you heard about a lot of different funds that had to, close up shop. But it doesn't work, in the other direction when you hedged and you were, quote unquote, practicing good risk management, and it still doesn't work out to your advantage. So I think that's a disservice.
Well said, and thanks for explaining that to our listeners and viewers, because it's just not something that's talked about enough. And your insights and your research that you produce really talk about that a lot. So I do appreciate that.
Thank you.
Well, Seth, we've taken enough time of your morning, so we want to let you get back to it. But for listeners that want to learn more about you or follow your work, where can they go?
Yeah, I mean, a lot. I do a lot of, posts on X. I'm still trying to get used to saying X as opposed to
I
Twitter.
know it's weird.
I know
isn't
it's weird, isn't it?
But at Seth CL on Twitter. And you can subscribe to my research, my investing strategies, my 2025 outlook, which will be published in the next couple of weeks, all at phenomgroup.com. That's FINOM.group.com, phenomgroup.com. So we do a lot of macro market research, a lot of quantitative data and analytics, really deep dive stuff to basically help investors think about the probable, future S&P 500 moves, based on what has happened in the past. And we're looking for probabilities. As I often say to investors, anything's possible. That's what you get on the financial media. That's what you get in social media. It's the possibilities. But there's a reason why the markets go up over time. That's the probability you always want to have in the back of your mind.
Yeah.
Well said, Seth.
Couldn't have thought of a better way to end it, so we'll leave it there. And obviously,
Thank
we
you,
will
guys.
try our best if you'll be so gracious and come back on sometime in 2025 to have another nice discussion.
Absolutely.
So thanks, Seth, and
Thank
thanks
you,
everybody
guys.
for listening to episode 276 with Seth Golden, and we will see you back next week.
Take care, everyone.
Bye-bye.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.